but also advanced financial management students can gain. But this is basically financial management. So when you talk of a portfolio basically is a collection of what here? A collection of investments. It's a collection of investments. A collection of investments. In this case here, why would we want investors here to collect many investments as they think about their budgets here, as they think about putting up investments? It's basically to reduce risk. So this is basically in line with the reduction of what here? Risk. Reduction of risk, business risk. Remember, we are not supposed to put all our eggs in one basket. You shall never put all your eggs in one basket. If you put all your eggs in one basket, of course, as you're walking to the market and you happen to stumble on some stone, that basket, you're going to lose all the eggs there. You're supposed to spread your risk as an investor. And that is why we have a very important formula that I'd always want you to remember. Under portfolio management, we have a very important formula called capital assets pricing formula. Capital assets, very important, shall come across this. Capital assets, pricing model, which tells us that when you are investing, ladies and gentlemen, you shall not put all your eggs in risky ventures alone. Serious investors must have risk-free investments. Serious investors must always have risk-free investments. Serious investors must invest with government. When you start making some little money here and there, you must always have some money with government in form of government bonds or treasury bills. Don't put all your eggs in one basket. Put some money in the stocks, government stocks, other money in Safaricom shares, East African breweries. Have what we call a money market fund. A money market fund. And I really, like I was telling you yesterday, my AFM students, I really sympathize with you guys. You guys, after you finish this paper, financial management, we expect you to start advising people outside here on matters of what here, how do they invest? And then you'll get some ninjas here who are almost now finishing financial management, but they don't have any, for example, account at CBK. They have never bought any bonds. They have never bought any treasury bills. They don't have a money market fund. Of course, most of them, they'll tell me, but Mwalimu, you're not employed. Even if you're not employed, opening a CSD account with CBK is free. It's done online. You simply open there, go and study, read the things to do with money market, what here, funds like that. So whenever we talk of CAPEM, we shall always be thinking of risk-free assets here. So this is called risk-free. And then from there, ladies and gentlemen, you go to the market assets here, what we call returns of the market. But you see, these returns of the market are risky. So what you do, you will come and subtract, in this case here, what we call risk-free. Risk-free. These ones here, normally, they fluctuate quite a lot. That's why we normally talk of expected returns of the market. And then outside here, we shall put what we call better. I haven't come across this, but I wanted to show you, my good students, that when you start getting your own monies, whatever capital assets you think about, we shall always have what we call risk-free assets, always. And these ones must be the first ones. Give money to the government. So we have here risk-free, plus in this case here, what we call expected returns of the market, minus risk-free, multiplied by beta. Now listen, ladies and gentlemen, this RF stands for risk-free rate. Risk-free rate of return. Risk-free rate of return. Risk-free rate of return. This ERM stands for expected returns of the market portfolio. Expected returns of market portfolio. Of market portfolio. Expected returns of market portfolio. And then, of course, we have beta. This beta, it's a measure of systematic risk. It's a measure, it is a measure of systematic, it is a measure of systematic what here? It is a measure of systematic risk. Remember, we have got two types of risks. We have what we call unsystematic risk, and we have systematic risk. From the word systematic, systemized, the same throughout. That risk that you can never diversify, you can never run away from. You go to this industry, you'll get systematic risk. You go to industry B, you'll get systematic risk. Like inflation is that kind of a factor that affects all industries of an economy, all companies in an economy. So whenever we talk of systematic risk, I'll be defining this better. These are those risks that are uniformly distributed in a given economy. When you go to this industry, you find them. Wherever you go, you will find them. So have you guys been able to take a note of this? Have you ninjas been able to take a note of this? Have you been able to take a note of this so that I can know how to progress with this? So what have we learned here? Mostly, these are CAPM returns. Any serious investor must always start with what here? Risk-free. Any serious investor. Let me ask you a simple question. Could we be having some students here who don't have any money market fund account? Do we have some students who don't have any money market fund account in Zimele, the standard chartered bank shilling? Oh, okay. Okay. So who was the first one to say Mimi? Who was the first one to say Mimi? I want to open something for somebody. I want to be a blessing in this case here to somebody here. The first one who was very honest and said, who was the very first one to say, who was the very first one here to say, Hana, tumtumie kitu afungue. Nataka afungue. All of us, no. Tutarudi hapo tujue nani alikuwa wa kwanza kusema ukweli. And now, ladies and gentlemen, for the sake of your exams, normally this is what will happen. For the sake of your exams, this is what will happen. There are two technicalities. You will be given here returns of two securities. We have returns of A, and then we have returns of B. Let me call them X and Y. Returns of X, and then we have returns of Y, like that, in form of percentages. And then we'll be given here states of the economy. You know, the economy can dance anyway. So A, B, C, for example. So if it's A that will prevail, then A will give us 10. If it's B that will prevail, then X gives us, for example, 12. This one here, 14, like that. So for Y, could be quite close. So we have 12 there, maybe 18, maybe 21, like that. So then, ladies and gentlemen, you are required here very fast. You see, we have two securities. This could be shares of Safaricom, shares of KCB, behaving differently according to what here the states of the. First of all, I should have taught you a situation where we are given probabilities. When we're given probabilities, things are very easy for us. The probabilities must always add up to what here? Must always add up to 1. These probabilities will be given the probability. They must always add up to 1. So we are required very fast here to ascertain what we call expected returns. Expected returns. And I would want in this case here, we calculate ERX. Why are we calculating expected returns? Why are we calculating expected returns? It's because for our decision making, we can't afford to make decisions in this haphazard. I mean, returns are different. So we want to get average. We want to get average. So how do we get the average? In light of probabilistic information, to get expected returns, you will take the actual returns given times their corresponding probabilities, like that. You take the actual returns given times their corresponding probabilities. So basically, whenever they want you to get the expected return, you do what we call tata, you add. So you multiply, you add. So then what do we have, ladies and gentlemen, for X? I can see it is either I get 10 with this probability, or means in probability I add, or I get 12, depending on how the economy behaves, times 0.3. Or we get this 14 times 0.6. Is there somebody who is able to give us this figure? Is there somebody who is able to give us this figure? Yeah, I'll be able to show you all. So we have here 13. Thank you very much. Then we have here expected returns of Y. Tata, because probabilities are the same. Tata. So we have here 12 times 0.1 plus 18 times what here? 0.3 plus, in this case here, 21 times 0.6. So is there somebody who could be having this answer for us? I don't know whether you guys are able to follow, or am I too fast? If I'm too fast, please don't hesitate telling me, Mwalimu, you are very fast. But I like students who keep on using emojis. I like students who keep on using emotions. That's why I love when I see some students, in this case here, for example, like Mwalimu akimiss class, nakuta kuna wanafunzi tu wanaendelea kufanya homework zao. Wako sawa. Kuna wengine, these are very good. They are called emoticons, emojis. So even here, you should be able to use them. If you feel I'm moving very fast, unaonyesha emotions zako. Kuna wengine unapiga makofi. Kuna wengine unaweka kidole hivi down. Mwalimu, you are not teaching anything. Useless. And then we shall overcome. Now, ladies and gentlemen, after you've gotten expected returns, before I look at one where you're not given probabilities, This examiner would want you to calculate standard deviation. Standard deviation. How do we get the standard deviation? So standard deviation for the securities, we shall write standard deviation. Unaandika 0 unavuta mkia. Iko mwingine anaandika mitochondria anaandika hivi ati ndio symbol ya unaandika 0 unavuta mkia kidogo. So standard deviation of x. Standard deviation of x. Standard deviation of x. Listen, this is very easy and it's going to save you in your exams. To get standard deviation of x, ladies and gentlemen, this is the difference between two types. You know, deviation means subtraction. So we have here actual returns of x minus expected returns of x, like that. And then from high school, if you went to a good high school, I'm so sure everybody went to a good high school, you are told that standard deviation is the same as what we call root mean square. If you remember RMS, root mean square. And normally we start from here. Once you get this deviation, this being a special deviation, you start by squaring. Mean is expectation. You attach probabilities here. And because there are many, before you get a square root, you must come and sum. You must come there and sum. And then now you come and do what here? Give us a big square root on top. A big square root on top. It doesn't matter which standard deviation they want us to give them. If they want me to give them standard deviation of y, this is very easy. I'm a statistician. I know I'll come and compare the actual returns of y with the expected returns of y. These have to be squared. We must multiply with probabilities because there are many we must sum. And then at the end of the day, we do what here? Square root. You'll get in this case here times the devil visits students. Unapata mwingine amesema hapa rx minus ery. Haziwezi enda hivyo. Lazima ikuwe consistent. It is actual versus what here versus expected. It's actual versus expected. So, ladies and gentlemen, I would want us to do this. I would want us now to create a table here and capture this rx minus erx squared times probability. Let's create this table. So first of all, abracadabra, I will copy these are the, without e, these are the actual returns of x. So abracadabra, we have 10, 12. We have 14 minus. Expected returns of x. Is there somebody who can remind us the expected returns of x? We got expected returns of x. Thank you, NJ. Is it 12? Is it 12? You ninja, Danson. Wongo. It is 13. But at least you have given us a figure. So 13. Then you come and do what here, abracadabra? Come and square them. You square them pole. You square them pole kama ninja. Unafuata formula. And then the next thing they want you is to go and pick the probability corresponding to these ones. So the corresponding probabilities, we have 0.1, 0.3, and then we have here point what here? 0.6. 0.9, ama ya kwanza ndio 0.9. Okay, nimeunderstand sasa. So hebu chukua bracket hapa, pole, tuende sasa pole. Unasema open brackets, unasema 10 minus 13 you close, you square times 0.1. So we have Leti, I believe this is Letitia, 0.9, the first one. Now, are we getting these figures, all of us, or are there lazy ninjas who are waiting for Mwalimu to write his answers and then they copy? In financial management, hakuna lazy ninja. All of us must get these answers. Next is 0.3. So unachukua open brackets, 12 minus 13, you close, you square times 0.3. Halafu unasema hii next hapa ni 0.3, eh? Ama ni 0.9, I don't know. Wengi hawajanipatia. Thank you very much, Mary Ann Salah. Thank you very much, Lewis Kaburu. Thank you very much, Lillian. Thank you very much, NJ. Matilda, great. So then Onduto tells me that the next one is supposed to be 0.1, 0.6, 0.6 next. Thank you very much. So you see, look at the formula. Unajua sasa utapata, mimi nakwambia tukimark, wanafunzi wana blame sana Kasneb. But siku moja, I wish Kasneb can make those papers bare, waonyeshe. Kasneb haina makosa. Unakuta kaninja kamekuja from nowhere, kanachapa square root kila mahali. Square root, angalia formula. Formula nakwambia kwanza you sum before kuweka square root. Wewe. Kuja hapa sum kwanza. Tupatie summation. So NJ anasema, this is 1 what here, this is 1.8. And actually I love the fact that he's able to call this one what here, variance, called variance. So after you've gotten this 1.8, now you can come and get what is the square root of that 1.8, like that, for you to get the standard deviation of X. Thank you so much. So 1.3416, 1.3416, 1.3416, 1.3416. Now, can we agree between ourselves? First of all, before we make an agreement, have we understood up to here? 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 Thank you so much. Thank you so much. Now, let me ask you a question. Can I leave you guys for y? You do y later so that I can do a different concept here. Can I leave you guys, you do the one of y later, or do you want Mwalimu to do it? Don't fear me. Students, don't fear me. Never fear. If you want me to do it here, tell me do it here. But I can see so many yeses telling me, Mwalimu, it is in order. Thank you very much. It's in order. So y, please leave space ya y kidogo. Utafanya returns of y kidogo, baadaye. But as I go for some different concept, you'll always get in your past papers, the examiner requiring you to compute the coefficient of variation. Very easy. Coefficient of variation, very easy, which is also a measure of risk, CV. Well, ukisikia examiner na kuambia utafute CV, remember that CV is sex in what year? Sex in percentage. That's the easiest way. You're supposed to remember this. Yeah, the easiest way. Ukiuza tu calculate CV, unasema CV is sex in percentage. Look at now these fellas who have corrupted minds. You. My sex here is what year? Gender. Ladies and what year? Gentlemen. So then this will help me like this. So I know the CV will be the standard deviation over X bar times 100. Standard deviation over X bar times 100. Times 100. So like now for A, the CV of A, is there somebody who is able to remind us the standard deviation we got? Is there somebody who is able to remind us the standard deviation we got? It is here, isn't it? 1.34, thank you very much. How about X bar? You see, X bar is the same as expected returns, is the mean. X bar. Do you remember X bar for this X? It is expected returns of X. It is expected returns of X. It is expected returns of X. So which is that? 13 times 100. So are you able to give me this answer? CV of A. Are you able to give me this answer? Are you able to give me this answer? Are you able to give me this answer? So kusema ukweli kabisa, iko mwanafunzi mwenye atawahi sahau formula ya CV. Utakai sahau formula ya CV kweli? Unaweza sahau formula ya CV? No, nobody can dare forget formula ya CV. No. Nobody will ever dare forget. All right. Now, before I know you guys have another class. Do you have a class at 8 p.m., the FM students? Do you have a class at 8 p.m.? Ama naweza nifunze pole pole. Oh, you're free. Wow. Then I should be able to get my cup of something here. Sasa mbona nakimbia? Too sad. No, Ruth AAA ni yenu. Mimi nasema hawa nini? Hawa wanafunzi wetu watoto hawa wadogo hawa wa FM na wale watoto wa sababu ni wako chini kidogo, but we shall overcome. Hiyo mtaendelea. Hiyo mtaendelea peke yenu. Sisi tunasema FM. Hawa wanafunzi wa AFM medandia klasi ya FM, which is very good. Unajua wanafunzi wengi wa intermediate level, most of them, hata ukiona wana make arguments, most of them must be at this age. Ukweli ama uongo? No, kwani mko na miaka ngapi? Si most of you mko hii miaka. Kusema tu ukweli kabisa. Douglas, do you want to tell me that there is somebody who is over 30 here in this group, including the ones who are doing AFM? Do we have anybody who is over 30 years? Oh, okay. Then basi hakuna mtoto basi. Hakuna mtoto hapo. Sasa tuende pole pole. Sasa utakuja upate kitu kama hii, Unaambiwa securities A and B will cost Kenya shillings 30 and 40 respectively. And then they'll give you guys returns of A, returns of B. So here we have, for example, this could be 32, this could be 35, this could be 38, this could be 35, this could be, for example, 42, this could be 50, like that. And then you are given probabilities. This is very popular in your exams. 0.3, 0.2, 0.5. Sorry, this is supposed to be returns in Kenya shillings, not percentages, not percentages, not percentages, not percentages. Hey, our returns, I'm 20, you can see, yes, I'm 20. Great, Franklin, much respect, 35, much respect here. Great. So if you are given returns in Kenya shillings, this is an examiner who wants you to get a 0 in the entire question. This examiner wants you to get a 0 in the entire question. He's a sadist of an examiner. He's not a very good examiner. Because for sure, if he gives you this kind of, Kenya shillings, our returns must always be in form of what here? Percentages. Our returns convert to percentages. Our returns must always be in form of percent. Let me ask you guys a simple question. This is bread. We buy at 60. We're doing business. Sell at 80. Can you kindly give me percentage profit? Kindly give me the profit in percentage form. So we are doing some business here. We've bought this bread at 60, and then we have sold at 8. Tukapata profit kambao ka 20. So please convert that to percentage now. Convert that to percentage. Convert that to percentage, just 16%. How I wish, but I'm giving a present now. You guys be serious. You guys be serious. I'm giving a present now. So between Justus and Danson, one of them will get a present. One of them will get a present. All right. So, ladies and gentlemen, if they want us to give them percentage profit, what do? Of course, we shall come here and take the selling price minus the buying price, all of our base, which should be the buying price, times 100. So selling price, hapa ni 80, minus our buying price, ambao ni 60, divided by our buying price, original price, which is 60. Whatever you get, so 80 minus 60, whatever you get, we divide by 60, you multiply with 100. So is there somebody who is getting 33 point something? Hiyo iko sawa? Paka hapa iko sawa, they have converted. Paka hapa iko sawa. Thank you so much. But again, if you get somebody doing this question this way, huyu sio serious ninja. Huyu anaweza kuwa ni maybe white belt ninja. Huyu sio black belt ninja. Because black belt ninja will tell you the easiest way of getting, in this case here, percentage profit. You take, in this case here, the new over the old minus 1. The new over the old minus 1. The new over the old minus. This is how serious black belt ninjas calculate their profits. New over old minus 1. So the new, of course, will be, selling price you are selling later. So the new here is 80 divided by the old, which is 60. Whatever we get, we subtract 1. And then whatever we shall get, ladies and gentlemen, to change to percentage, we do the abracadabra of multiplying it with 100. We do the abracadabra of multiplying it with 100. This is how a serious ninja should do this. Yes. So are we getting the same answers? Are we getting the same answers? Are we getting the same answers? Yes. So in that case here, for example, A is going to cost us, the buying price is 30. So what you do, unakuja unasema hapa divide by 30, divide by 30, divide by 30. Each one of them, remember, regardless of the outcome, the buying price of A is 30, regardless of the economic outcome. The buying price of A is 30. And the buying price of B is, unasema divide by 40, divide by 40, divide by 40. Sure there, unangoa 111, sure there, 111, sure there, 111. Unakuja hapo unasema sasa returns of A in form of percentages. So nakuja mtengenezea table nyingine, unasema returns of A percentage, returns of B percentage. So uking'oa ile 1 from Shiothe, whatever answer you get, unasema 32 divided by 30 equals -1. Whatever answer you get, you multiply with 100. Whatever answer you get. So like NJ has given me the first one. NJ has told me the first one is 6.6. Alafu hapo utapata ule white belt ninja. Ka white belt ninja, katasema 32 minus 1, 31. 31 divided by where? This one is normally independent. This one is normally independent. So all of us, are we able to see this? You divide first. 32 minus 30. Whatever answer we get minus 1 equals whatever answer we get times 100. All of us, are we able to get this 6.67? Si wengi wanasema. Wanafunzi nataka niwasaidie na hawataka kusaidiwa sasa. Waniambii kama wanapata 6.67. Hata waandiki answer. 6.67, It's only 3, imagine. Faiza, Lillian, and then NJ. Masim Nabuire, Matilda. 30 imetoka hapa. Thank you for asking a question. Securities A and B will cost. This is the handwriting is the worst in the world. Will cost. You see, A is costing 30. And now these are like the market prices. These are like the selling prices. I like Martina. This guy has even been able to give me this thing in bold. I did. Noor, have you seen the 30? I did. Have you seen the 30? I did. Great. Thank you so much. Thank you. Alafu B ni 40. Sasa B ni karibani na 40. Hivyo sasa. Aya. Kibisu Joan. Sasa nipatie basi answer ya pili. Answer ya pili ni ngapi? 35 over 30 minus 1. 35 over 30 minus 1. So ya pili inakuwa 16.67. Thank you so much. Ukiandika percentage hapa juu, hii usiandike percentage. No. Usiandike percentage. So inaenda namna hiyo. Ya mwisho, Migichi Linda, thank you so much. Migichi Linda, serious student. This is a serious student. 26.67. Enda kwa returns of B, sasa in form of percentage. Returns of B in form of percentage. Hapa mimi naona kuna Liza, Matilda, Linda. Wanaume ni moja kama Mosa Simbito. Wanaume ni wengi kweli darasa, ama wanaume wameamua wanyamaze? Wanaume wameamua wanyamaze ama vipi? Wewe msinyamazie wanaume, msinyamazie kusema ukweli. So NJ ananiambia the first one is a loss of 12.5. First one is a loss of 12.5. Thank you so much, Victor. Thank you so much, Victor. I like that. Thank you so much, Mary Ann Salah. Great. How about the second one now? 42 divided by 40 minus 1. 42 divided by 40 minus 1. What are we getting there? 5 seconds. 5 seconds. Okay. Or 5, Ala? Why are you calling them seconds? 5, okay. Ya mwisho kabisa itakuwa ngapi? 25, like that. 25. And then now you have here your probabilities. Sasa niulizeni swali, kutoka hapa si mnaweza endelea sasa kupata expected returns za A, kupata expected returns za B. Si hivyo mnaweza? Sio mnaweza sasa kabisa. Hiyo kupata my expected returns sasa ni tata na hiyo. Kama kawa, I like that. Kama kawa, I like that. Kama kawa, I like that. Tata, like that. But now I'm making a very bad assumption, and please, if you have a very new student, don't mistake me here. These are topics that these students have done before, because I'm so sure there must be somebody who is joining this class for the very first time. Now you're seeing a man with a very big head talking about white ninjas, black ninjas, abracadabra. Now you are wondering. You will be able to cover up. Trust you. You'll be able to catch up, because they're going to share with you these videos. Like, Francisca, first time. But Francisca, have you been able to follow something however small? Francisca, have you been able to follow something however small? Great. Oh, nijaribu correlation coefficient. Thank you very much. So if you want me to try correlation coefficient, then first of all, I'll give you guys the covariance. JM, thank you very much. So I'll come and give you guys the covariance. So for me to give you guys the covariance, then You have to give me these expected returns. Hakuna njia nyingine. Give me these expected returns on A. Hata si lazima uandike. Unajua ni tata plus. So inakuwa ni 6.67 times 0.3 plus 16.67 times 0.2. Akiwa ninja ameniuliza swali mrefu. Ninja ameniuliza swali mrefu. Unajua nitafanya vitu mingi sana hapa. But I like ninjas who ask questions. Expected returns. They want us to give them. We shall overcome. I can't be a white ninja. I'm a black belt ninja. Where Victor, I'm a black belt ninja. Big, yes, but black belt ninja. Lian is giving me a figure of 18.67. Can somebody confirm that? So which question are we doing? This gentleman wants me to calculate the correlation coefficient. 18.67. Then go ahead and give us expected returns of B. I like that. Minus 12.5 times 0.3 plus 5 times 0.2 plus 25 times 0.5, which in this case here will end up giving us what figure? So this gives us 9.75. So I need to pause there and get to see whether the very new students are able to get these answers. These new students, come up, Francisca, are you able to get this figure, Francisca? Please just use your calculator. Don't worry so much. Don't worry so much. Use your calculator. Use your calculator. Use your calculator. Use your calculator. Thank you so much, Neil. Thank you so much, Lisa. So we are supposed to finish this quite fast. So now we have gotten here expected returns of A and expected returns of B. So then if I'm the one doing this and you want me to correlate things, if you want me to correlate things, the very first thing that I will do is to come and calculate here the covariance between A and B. So come and give me the covariance between A and B. Andika in full covariance. Mimi nakwambia hakuna kitu mbaya kwanza kama ni mdemu. Upite mahali ukiwa mdemu, usikie mtu anasema jina ko. Ukipita mahali usikie mtu amesema co-wife. Mimi nakwambia kitu ni hatari sana. Inamaanisha kwamba there is something being shared. You should run. So whenever they talk of covariance, this is the shared variance. This is the shared variance. I don't know what they are sharing, but ukisikia tu unaitwa co-wife. Hatari. Shared variance. Hata nyinyi vijana mnakuwa na mambo mbaya. Mbona sasa unaoa bibi wawili? Unawaletea shida. Unawaletea shida sana. So covariance is the shared variance. Sasa nataka mnielewe from the beginning to the very end. So when we talk of covariance between A and B, so hapa wamama ni wawili. Wamama wa covariance wanakuwa wawili na kila mtu akona defects zake, akona mashida zake. Unajua mama, kuwa mama si kitu rahisi wewe. Cheza sana. So in this case unachukua deviation of A times deviation of B times deviation of B. And then you multiply in this case here with what here? With probability, and then you add. So anytime we talk of covariance of A and B, you take the deviation of A times the deviation of B times the probability. Deviation of A, how do we get these deviations? It's very easy. You will take the returns of A minus expected returns of A into deviation of B. You take the returns of B minus expected return of B. And then you come and multiply here with probability, like that. This is a formula that everybody should be able to master. It's a formula that everybody should be able to master. Iko mwanafunzi ameishika. Iko mwanafunzi ameishika hiyo formula. Iko mwanafunzi ameshashika hiyo formula kweli. Yeah. So kisikia tu forget about everything else. But covariance, honestly, especially when you are a lady and you understand these issues to do with character development, Character development, usahau ya covariance. Usahau ya covariance. Usahau ya covariance. Usahau ya covariance. Hii ni character development. You can imagine for so many years you've been thinking you are alone. Alafu kaninja kanatokezea na mama mwingine ako na watoto wakubwa, unashangaa how comes uko umejua siku zote. So mama ni wawili. So this is very, very good. Ladies and gentlemen, I can now delete this and then now we work this thing out very easily. Sasa unakuja hapo unatengeneza ka table, ukikuwa na furaha. So unajua hapa ni returns of A. Returns of hizi za percentage hizi. Unaweka 6.67, unaweka 16.67, unapick kwanza the actuals. You pick the actual returns of A. Unasema abracadabra minus, una follow hii. Expected returns of A ni 18.67, 18.67, 18.67, 18.67. So unakuja hapo unaweka brackets, unafuata hii actuals of B. Actuals of B are these ones. So actuals of B are these ones. Minus 12.5, 5, 25. Iko bana ni box hapa ananiambia kwanza mimi nishafanywa hiyo character development. Pole, you shall overcome. You shall overcome. Don't worry. Every door that is closed, there is always a new one. Just vumilia maisha namna hiyo. Vumilia. So in this case here we have actual returns of B. Usiende horizontal hapana. Hii ndio ninja black belt ninja nafanya. Actual returns of B ndio hii na copy. Unakuja unasema minus. Are you able to see the expected return of B? It is here. So it is 9.75, 9.75, 9.75, like that. Times the probabilities we are given here. Probabilities we have 0.3. Here we have 0.2. Here we have 0.5, like that. Sasa unaanza kwenda horizontal yako fazia. Sasa unachukua calculator unasema open brackets, 6.67 minus 18.67, katikati unasema times na open bracket. Usifanya moja, minus 12.5 minus 9.75, you close, times 0.3. Alafu unanipatia figure, abracadabra. Ya kwanza hapa, Victor, inakuwa ngapi? Ya kwanza inakuwa ngapi? Oh, it's only Linda who is giving. And NJ, these guys are giving me answers. These guys, how I wish these answers were coming from everybody for us to see whether we are following really. Aisha has given me, I think, the second one now. Aisha is giving me the second one. Mary Salah, Maureen, 80.1. Thank you so much. How about the second one now? Aisha hiyo umepata ni uongo Aisha. Minus 5.97 Aisha na kasi ya ukweli. Aisha hukutumia board mass vizuri. Hebu chukua tu calculator yako sema open brackets. Kwanza useme on. Open bracket. 6 pole tu 6.67 minus 18.67 you close times open bracket minus 12.5 minus 9.75 you close times 0.3 alafu useme equals. Nitakungoja mpaka Aisha niambie kama umepata hiyo 80.1 Aisha. Aisha nitakungoja. I'm very patient. Ngoja Aisha niambie amepata. Ukitumia tu brackets vizuri utapata. Wanafunzi washapata ya pili 1.9 lakini nangojea sana Aisha ni confirmie. Thank you Mercy Chepkirui, Eunice Mwaka, thank you very much with the 1.9. How about the last one? 61. Elizabeth umefanyaje ndio upate 97.5? Hii ni 61. Imagine Elizabeth kuna makosa mnafanya. Alafu unajua ukifanya hizi figures kando utapata wrong. Elizabeth angalia, chukua tu calculator yako pole. Twende na wewe. I wish I had I have it here. I have my calculator. I don't work without a calculator. So I'll come and put on ndio kitu ya kwanza. Black belt ninja. Unasema open brackets. Unasema 6.67 minus 18.67. You close. Unasema tu close brackets. Katikati hapo always introduce ka times tu. So unajua kako hapo. So unasema times. Usahau ku open bracket. Usahau ile minus 12.5 minus 9.75 you close. Usikasema plus ama equals. Wewe sema times 0.3. Utasema equals mwisho kabisa. Nasema hapa SD 80.1 like that. Aisha ja confirm kama amepata correct answer. Sijui Aisha nini shida ja confirm. Ama mnatumia mobile phone kama calculator. So then we need the summation here. we need the summation here. We need the summation here. So covariance is 143. Elizabeth, great. Black belt ninja now. Black belt ninja. Promotion. 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 So this is what we call covariance. Covariance between A and B is 143, like that. 143, let me add. So is that correct, ladies and gentlemen? Is that correct, ladies and gentlemen? Is that correct, ladies and gentlemen? Is that correct? Is that correct? Great, great. Thank you so much. Thank you so much. Now from there, I will go, after I've gotten covariance, I would want to get the standard deviation of each one of them. I get the standard deviation of A. I will get the standard deviation of A. Hiyo mimi najua formula sana. Hata iweze kunichukua dakika mbili kuandika. Haiwezi kunichukua dakika mbili. Can I rub this, ladies and gentlemen? Can I rub this? Can I rub this now? All right. So this is now gone. 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 So now we'll come and give them the standard deviation of A. Deviation means subtraction. So I'll talk about returns of A minus expected returns of A. And then this has to be square times probability. Of course, there are many of them, summation. And then from there, we'll come and put what here? A square root. We'll come and put a square root. Put a square root. All right. Then now we come and take in these returns of A. We have the actual returns of A, abracadabra, 6.67, 16.67. Then we have 26.67. Then you say minus, minus, minus. Fortunately, expected returns, you guys had given me the expected returns of A, but I rubbed mine and I've forgotten it. I rubbed mine and I've forgotten it. 18.67. So expected return wanga haichange. Ndio maana unajua high school wanafunzi kuna vitu wanafunzi hawaelewi sana. High school ukiwafunza ukiwaambia inaitwa X bar. X bar, this bar means uniform throughout. So uwezi ukasema ati 18.67 hapo usitumie 20 at 30. Expected return, they are known and they always remain constant. They remain constant. Kwa hivyo hapo inakuwa 18.67, 18.67, unakuja unaweka brackets namna hii, abracadabra, we are squaring, times, probabilities. So are you able to see the probabilities here? Are you able to see the probabilities? Are you able to see the probabilities? So we have 0.3, we have 0.2, we have 0.5. Unakuja hapo unasema equals. Usiweke anywhere square root kwanza. Square root huja after summation. So abracadabra. Unakuja hapa kama black belt ninja mwenye ugopi unasema on always. Unakuja unapata amefinya vitu mingi na iko off. Unasema hapa open bracket 6.67. Unasema minus 18.67. Una close unasema squared. Whatever answer unapata unasema times 0.3. Unasema equals. Black belt ninja, what are you guys getting there? 43 point what here? 43.2. 43.2. Now, ladies and gentlemen, you go to the second one and do the same. Shida pia wanafunzi wengi, so many students in this case are really fearful. When you fear that you will get it wrong, you shall get it wrong. You should be able to punch this thing without fearing anything. Like Mercy Chep Creed there, like Kwamboka there, like NJ there, Lillian there, 0.8, the second one, 0.8. And then, ladies and gentlemen, we have the third one. The third one, what do we have here? The third one is 32. I'm told 32. So come here and give me the variance first. It's called variance of A. Add. Summation. You add. Now we are adding. According to NJ, this is 76. And therefore, the square root here will be the square root of 76. The square root of 76, ladies and gentlemen. The square root of 76, ladies and gentlemen, it is 8.72. Are we together up to here, my friends? Are we together up to here, my friends? Are we together up to here, my friends? All right. Nobody's saying no. It means that I can even now increase the speed as we finish. I can increase the speed. All right. Now, ladies and gentlemen, I'm so sure here there are very new students that I've never taught before, who have not joined RCM. Do we have such kind of students here? They are my guests. I invited them. Do we have anybody who has not made a decision, who has not yet joined RCM? Even one or two. Even one or two who has not yet joined RCM. Guests. I'm looking for my guests. It will be very bad if I don't have any guests. You guys should have brought me guests. You guys should have brought me guests. You guys should have brought me guests. You can see now I don't have any. I don't have any guests. Sorry to condemn you already. No, you should bring me next time when it's a free of charge class. You should bring me guests, because guests, we should be able to convert them. They become what here? Our members here. Then we have a standard deviation of B. Standard deviation of B. Standard deviation of B. So standard deviation of B, what do we have here? Standard deviation of B. So standard deviation of B, of course, I can't start with the square root. Somebody told me some time back that when they hear the word square root, this person is coming from Rift Valley, when they spell, they're a bit tired like now. So when I use the word square root, then they imagine capital root. Capital root is like a small animal, a small kind of, no. Don't start with those capital roots here. Don't start with those square roots here. It is standard deviation. So it is RB minus, in this case here, expected returns of B. So square them, probability, sum, and square root like that. Square root like that. Returns of B are given here. So it is minus 12.5. Then we have 5. Then we have 25. Minus. Expected returns of B. You guys have to remind me these expected returns of B. 9.75. So we have 9.75, 9.75, 9.75. Then you come under, ladies and gentlemen, in this case here, square, times the probabilities. Times the probabilities. Our probabilities are here. 0.3, 0.2, 0.3, 0.2, 0.3, and then we have 0.5 like that. So then you should be able to do what here? You should be able to, open brackets, minus 12.5, minus 9.75, you square, times 0.3. You give me an answer. And if you're not able to get an answer, it's my role to show you. You should be able to tell me, Mwalimu sijapata answer. Please show me how you got it. 148.52. So 148.52, and then you go for the second one. So 5 minus 9.75, you square, times 0.2, times 0.2, times 0.2. You give me an answer, 4.51. So here we have 4.51, and then lastly, open brackets, 25, minus 9.75. You close square, times 0.5. So what are we getting here? 116.28. 116.28. Then come and sum for us. Give us the variance of boy. Give us the variance of B. Give us the variance of boy. Give us the variance of boy. Give us the variance of boy. 269.31. 269.31. So square root of 269.31. Which will end up giving us what figure as the standard deviation of boy? 16.41. 16.41. And then remember here, you need to go and revisit this area. You revise this area severally. So now we are done. What we need to do is to come and give our examiner the formula of correlation coefficient. Correlation coefficient. So this is the correlation coefficient. So the correlation coefficient, it is the standardized covariance. The standardized covariance. So if they tell me to give them the correlation between A and B, I will remember it's standardized covariance. So basically take the covariance you have, you divide this by the respective standard deviation. You divide this by the respective standard deviation. So correlation between A and B equals covariance of A and B divided by the standard deviations of the two securities. Unfortunately, I had rubbed mine. What is the covariance between A and B? We had obtained it up there. The covariance of A and B, it was coming to 143. 143. All over the respective standard. At least I know ya B ni 16.41. Ya AJ ilikuwa ngapi? Ya AJ ilikuwa ngapi? 8.72 like that. So then please go ahead and give me 143 divided by, open brackets for the denominator, or do the denominator by the side. 143 divided by, open brackets, 8.72 times 16.41. And then you give me an answer. You give me an answer, 0.999, 0.999, 0.999, which is the same as 1. Basically, this is a correlation. So the association between A and B is 100%. Is 100%. So when we have such a high, we call it positively, perfectly correlated. Perfectly, or rather positively, perfectly correlated. Is it very good for you as an investor in this case here to go for those securities which have a perfect association? Is it good? You buy A and B, which have a perfect association. Why would I do that? If they really relate with each other, I would rather buy one and then I diversify by going to another industry. We don't invest in perfect relationships. Never, 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 never even admire perfect relationships, including when you see, for example, your pastor at church calling the wife baby, baby, they are holding hands. Those kind of perfect relationships are very dangerous. So this association in this case is very high. As an investor, I have to drop one. I have to drop one. I have to drop one. So I can only invest in A. Perfect positive relationships. Hakuna kitu kama hiyo in life. Hakuna kitu kama in life. Hakuna kitu kama in life. Yeah, those are red flags. Just like the ladies who are in the house. If you get, in this case here, a house help who pretends to be like 100%, know that there is a problem. Unataka ule mnawaruzana, hata usifukuze, kaa naye miaka mingi. Kama mimi nimekaa na wangu 16 years. Paka sasa tutaka kurelease yeye sasa, sababu watu wamekuwa kubwa. Alright? Hata ukipata mwana kupatia 40%, 40%, wewe ni mzuri sana. Yeah, sababu hakuna mtu hata wewe mwenyewe uko 100%. Hata wewe mwenyewe uko 100%. Yeah. So, ukipata 100%, and that's how you interpret it. 100% relationships, associations here, they are risky for the investor. The investor, the investor, ladies and gentlemen, I've saved some Ghana job. Don't fire them. Trust you me. Trust you me. Don't fire them. So long as they're able to give even 40%, and they are themselves, not unless ni wale ambao wanaenda extra na piga watoto ama nini. Kama ni normal, anakupata 40% in this life. Even your own brother, your own sister times can't give even 10%. Why would you want somebody you are not born with to give you 80%, to give you 100%? So, ladies and gentlemen, I would want to end the session there. I'm sorry, really, for what happened. We kept these FM students in waiting. I was having my AFM class here, so I never knew that kind of a thing was happening. Not AFM, I was teaching AMA. Actually, I had to cancel my AMA class to come and rescue the situation. But all in all, in life, usikue kama nimeona mwingine anasema hapo, ati I'm regretting for being in RCM. Which teacher will be able to summarize this kind of a concept in 30 minutes? You should be able to look at glass being half full, not half empty. So as much as, of course, it's good to open up, but don't go extremes, really. Don't go extremes. I mean, you guys have a lot. As teachers, you are not perfect, but neither you guys, you aren't perfect. There are homeworks you have been given, you haven't done. All right? All right? So don't go extremes. You know, the moment you start, in this case, you're hating on a teacher, like this is something I normally tell even the high school students. Once you start hating on it, that is automatically a fail. You rest assured. You need to know that this is a ninja. Ninjas at times can go wrong. Ninjas can go wrong. Ninjas can go wrong. We go above and beyond. Thank you very much. Yeah. So as much as ikiwa mbaya sana ndio taona, lakini given that you have got a standby teacher like myself who can come in and hata kesho sasa kama hizi class ambao nawafanyia za remedial kama ile nimewafanyia asubuhi, ni shule gani iko nazo? If